life insurance. For a lot of us, it's this thing you buy for peace of mind, and then you just forget about it. But what if I told you there are hidden tax traps lurking inside some policies? Traps that could catch you completely off guard. Today, we're going to pull back the curtain on the tax side of life insurance here in Canada.
Okay, first things first, let's talk about the big one, the main reason we all get life insurance, the death benefit. When you pass away, the money that goes to your loved ones is completely, and I mean 100%, tax-free. That's the core promise, and it's a huge deal.
But to really get a feel for just how powerful that is, let's not talk in hypotheticals. Let's look at a real-life example of what this looks like.
This is what Susan received after her husband Andrew passed away. Now get this, over the life of their policy, they had only paid about $2,300 in premiums, and yet that entire $500,000 payout landed in Susan's bank account without the tax man taking a single penny. It's an incredible illustration of that core benefit.
And look, this rule is ironclad. It doesn't matter if you have a simple term policy or a big whole life policy, or whether you've paid into it for 2 years or 50 years. The source material couldn't be clearer. The death benefit is exempt from tax, full stop. It is the absolute bedrock of how personal life insurance works in this country.
So the death benefit part is simple, right? Pretty straightforward. But here's where the whole story takes a sharp turn. See, many permanent life insurance policies build up a cash value over time, money you can actually use while you're still alive. And the moment you decide to touch that money, well, that's when a whole different set of rules kicks in.
And this, right here, is the heart of what we're talking about today, the living benefit tax trap. The second you access your policy's cash value, you might, just might, be triggering a taxable event you didn't even know existed.
Now, the official kind of jargony term for this is a policy disposition. But all that really means is you did something to get money out of your policy. Cashing it in, taking a policy loan, making a withdrawal, all of those things are considered dispositions. And every single one of them makes the Canada Revenue Agency take a closer look.
So, when one of these dispositions happens, how do they figure out if you owe tax? Well, thankfully, it's not some big mystery. It all comes down to one single, really important formula. If you understand this one formula, you understand the whole game. Here it is. Any taxable income you have is called a policy gain. And to figure it out, you take the money you got out, that's the proceeds, and you subtract your cost. Now that cost has a special name, the Adjusted Cost Basis, or ACB for short. Whatever's left over is your policy gain, and here's the kicker. It's taxed as 100% regular income, not a capital gain, but income.
So what on earth is this Adjusted Cost Basis, or ACB? Honestly, the easiest way to think about it is like the cost of a house you bought. It's what the government considers your cost for tax purposes. And you want this number to be as high as possible, right? Because the higher your ACB, the lower your policy gain and the less tax you have to pay. A high ACB is your best friend in this scenario.
But, and this is a huge but, figuring out your ACB isn't always simple, because the rules for calculating it have changed over the years. It all depends on when your policy was actually issued. In fact, there are basically 3 different generations of policies, and each one has its own rules.
So here they are. First, you've got the old-school G1 or grandfathered policies from before late 1982. Then you have the G2 policies, which cover this huge stretch of time all the way to the end of 2016. And finally, you have the modern G3 policies, which is basically anything new from 2017 on. Knowing which generation your policy belongs to is absolutely critical.
And here's why that matters so much. For those old G1 policies, the ACB is pretty simple. It's just the total premiums you've paid in minus any dividends you've received. But for all the newer G2 and G3 policies, there's a wrinkle. The formula also subtracts something called the net cost of pure insurance, or NCPI. You can think of the NCPI as the real internal cost of your death benefit each year. And as you get older, that cost goes up, which actually grinds down your ACB over time, sometimes all the way to zero.
Okay, enough with the theory and the acronyms. Let's make this real. Let's run through a couple of scenarios to see exactly how this tax trap can spring on someone who isn't prepared for it.
So let's meet Alicia. She's got a whole life policy, and she's thinking about just cashing it out completely. In the insurance world, this is called a full surrender, and it is a classic disposition event.
Let's do the math. The cash value in her policy is $24,000. That's her proceeds. Her ACB, or her tax cost, is $10,000. So we subtract that, and what's left is a policy gain of $14,000. Assuming a 35% tax rate, boom! She's suddenly facing a surprise tax bill for almost $5,000. That's a huge piece of her cash value that's just gone.
All right, now let's look at Janine. Her situation is a little different and maybe even more common. She doesn't want to cancel her policy. She just wants to take out some of the cash that's built up inside her universal life policy. This is where things can get really tricky.
Okay, so Janine pulls out $40,000, which is exactly half of her total $80,000 cash value. Now, you might think, great, she's got a $65,000 ACB, so she can take out $40,000 tax-free. But nope, that's not how it works. The rule is you have to apply your ACB proportionally. Since she took out 50% of the cash, she only gets to use 50% of her cost basis. That's $32,500, which leaves her with a taxable gain of $7,500 and a tax bill of over $2,600 that she almost certainly wasn't expecting.
And this just goes to show you how much your choices matter. If we go back to Alicia's policy for a second, a full surrender creates that $14,000 gain. But what if she just surrendered 25% of the policy instead? Well, then her gain and her tax bill would also be proportionally smaller. It's the exact same policy, but two very different actions lead to two vastly different tax outcomes.
So let's just quickly boil this all down. What are the key things to remember? Number one, the death benefit is your tax-free haven. That's simple. Number two, touching the cash value while you're alive is called a disposition, and it can trigger taxes. Number three, that tax is calculated on your policy gain. And how do you find that? Well, it's just your proceeds minus your ACB. And finally, and maybe most importantly, how you calculate that ACB all comes down to whether you have a G1, G2, or G3 policy. Which really just leaves us with one final, and I think pretty important question for you. If you have a life insurance policy, you definitely know the size of your death benefit. It's that big number on the first page. But do you have any idea what your adjusted cost basis is? Because as we've just seen, if you ever plan on using that policy while you're still living, that second number is every bit as important as the first. Maybe something to look into.